So, what actually happens when an artificial intelligence goes head to head with the wisdom of the crowd? You've probably noticed that prediction markets have completely exploded into the mainstream lately. I mean, they've gone from this super niche economic theory to front page news forecasting literally everything from macroeconomic shifts to the latest pop culture outcomes. And they do something that your standard software simply cannot do. They put a concrete, real time price on the future. Today, we're diving into what happens when an AI agent looks at that price and thinks, you know what, I might actually know better. To really wrap our heads around this, let's just look at a basic prediction market contract. Say a contract is trading at 62 cents. What does that mean? It essentially means a whole crowd of people with their own hard-earned money on the line is collectively saying, hey, we think this event has about a 62% chance of happening. It's actually a pretty remarkable mechanism. Unlike a random internet poll where literally anyone can just click a button with zero consequences, this requires a concrete financial commitment. It gives us this continuously updated, money-weighted probability for a question that hasn't even been answered yet, and it's reacting in real time to every single piece of news that breaks.
Welcome to The Explainer. I am so thrilled to guide you through this today because we are breaking down a really fascinating open source experiment called Polybot. So Polybot is a trading bot built specifically for Polymarket, and it asks a very simple yet honestly incredibly dangerous question. Can an AI agent, reading the exact same public information as everyone else on the internet, form a probability estimate good enough to actually disagree with the market? And perhaps the much bigger question, should it ever actually act on that disagreement?
Okay, let's take a quick look at the roadmap for today's explainer. We're going to cover 1. Pricing the future, 2. The baseline reality, 3. Finding the gap, 4. The art of inaction, and finally 5. A research artifact. Section 1. Pricing the future, the dense information of markets. Okay, so we have to start with the humbling part here. A market price isn't just some random number pulled out of thin air. It aggregates the information, the opinions, the rumors, and the actual cash of every single person trading it. That makes these prices incredibly informationally dense. And a lot of the time, they are highly accurate, which is exactly why beating them is notoriously difficult. Honestly, betting against the market is kind of like playing tug of war against 1,000 people. The AI is completely on its own against the collective weight of the crowd. So, the absolute crucial point here is that the default assumption for any system, whether it's powered by some advanced AI or just human intuition, that claims to have an edge against a market should be deep, unwavering skepticism. Not excitement, but skepticism, because most attempts simply end up with the market being right and the clever system being, well, wrong. Moving on to Section 2, the baseline reality, the honest bear case. Before we go even one step further, let's be explicitly clear. This is absolutely not financial advice, nor is it a recommendation to trade, invest, or use this software. As the source material outlines, automated trading carries a massive risk of loss, up to and including losing all of your capital. Automated bots, you see, lack that crucial human pause that might save you from making a really catastrophic decision. On top of that, prediction market access is legally restricted or outright prohibited in a lot of jurisdictions, and that includes for U.S. persons. You also have to deal with the reality of AI models. We know they can be structurally, confidently wrong. They'll often hallucinate completely incorrect probabilities with absolute fluency. And then add in the fact that backtests almost always fodder the strategy, meaning a simulated past performance completely fails to account for live market slippage, where the price actually moves away from you as you try to buy. Oh, and merciless transaction fees will quickly eat up any thin theoretical edges you thought you had. So, treating this strictly as a research tool is absolutely vital. Do not view this as a guaranteed path to returns. Section 3. Finding the gap. The mechanics of the hypothesized edge. With those massive risks clearly established, let's explore how Polybot actually tries to find an advantage. The core idea here is actually strikingly clean. Polybot researches a markets question using public information from all across the web, and then it forms its own independent probability estimate. After that, it compares its internal estimate directly against the market's implied price. The hypothetical edge here is found purely in the gap between those two numbers. Let's say the market prices an event at 60%, right? But the AI has rigorously determined it actually has an 80% chance of occurring. Well, that 20% delta is where the action is. The entire strategy hinges on whether the AI's independent synthesis of information is somehow seeing a pattern or maybe a piece of data that the massive money-weighted crowd is completely missing. Section 4. The art of inaction. Editing by subtraction. This brings us to what is perhaps the most counterintuitive, yet absolutely critical part of Polybot's entire design. Its process is so fascinating. It researches, it forms an estimate, it compares that to the market, and then its default action is to do absolutely nothing. See, a naive trading bot, one driven by a bias toward action, well, it wants to trade on every single disagreement it spots. But a sane, well-engineered system treats that gap as a mere hypothesis. It only acts if the gap is remarkably large enough to survive the transaction fees, the inevitable slippage, and the high likelihood that the language model is, well, simply hallucinating. This concept is called editing by subtraction. A bot that trades constantly is just a bot bleeding capital into noise. Polybot is intentionally designed to trade rarely, to keep any position sizes incredibly small, and to treat not trading as the normal, expected, and ultimately correct outcome.
Section 5, a research artifact, transparent methodology over returns. Let's shift our focus away from the illusion of a money-making machine and look at Polybot's actual intended purpose. Polybot isn't some proprietary black box trying to sell you a hefty monthly subscription. Now, it is MIT licensed and fully open source. It's local first, which means you run it securely on your own compute infrastructure. It's also provider agnostic, and that is a massive benefit. Say OpenAI has an outage, or Anthropic updates their model in a way that just completely breaks your flow. You aren't locked in. The forecasting AI model is entirely swappable. Because frankly, no single tech company's model should be blindly trusted as an infallible oracle. But the most vital feature here is that the whole system is completely auditable. Since it systematically records its reasoning for every single estimate it makes, you can actually go back after the fact and ask, wait, why did it think this specific event was mispriced? It basically turns what would otherwise be blind gambling into a highly inspectable scientific forecasting notebook.
And all of this auditability brilliantly serves the ultimate metric of success for a project like this: calibration. Now, success in forecasting isn't about winning one lucky bet on some crazy long shot. I mean, even a stopped clock is right twice a day, right? The real rigorous test is calibration over a long timeline. Think of it this way. If the AI routinely says an event is 70% likely, does that specific class of event actually happen exactly 70% of the time when you zoom way out across hundreds and hundreds of estimates? That is a slow, unglamorous, and often tedious measurement, but it is absolutely the gold standard that any serious forecasting system has to be held to. If a system isn't calibrated, it's really just a confident guesser with a bit of extra computer code attached to it.
The absolute core thesis of our source material today is so simple, but so important. Treat it as a way to study forecasting, not a way to fund a lifestyle. When you hold it to the standard of an educational research artifact, Polybot is an incredibly sharp, useful tool. It encodes real risk discipline directly into its architecture instead of just hiding it behind flashy promises. But if you hold it to literally any other standard, like if you look at it as some frictionless path to passive income, it is simply a highly efficient way to lose your capital with just a few extra steps. Which leaves us with this final, lingering thought to walk away with. The true value of studying Polybot isn't in trying to beat the market today. It's in observing the very frontier of what software can actually do. As these large language models rapidly evolve and gain much better reasoning capabilities, we now have an open, inspectable way to watch them attempt to predict the future. So, the big question remains: when, if ever, will an AI's forecast reliably and accurately diverge from human market consensus in a way that is mathematically sound? Now that is an experiment worth watching closely. Thank you so much for joining me on this explainer today. Keep asking great questions, and I'll catch you on the next one.